Income statement analysis is the process of evaluating a company's income statement to understand its financial performance over a specific period. The income statement, also known as the profit and loss statement, highlights the company's revenues, expenses, and net income, offering insights into how much money the company made, spent, and profited. Let's break it down simply with an example. The income statement has three primary components: revenues, expenses, and net income. Revenues represent the total money earned from the company's operations, such as sales or services. Expenses are the costs incurred to generate those revenues, such as wages, rent, materials, and marketing. Net income, often called profit, is the amount left after all expenses are subtracted from revenues. For instance, imagine a small bakery has $50,000 in revenues for the month. Its expenses include $15,000 for rent and utilities, $20,000 for wages, and $10,000 for supplies, totaling $45,000. The net income is calculated as $50,000 to $45,000 equals $5,000. This means the bakery made a $5,000 profit for the month. Analyzing an income statement involves focusing on a few key metrics. First, there's the gross profit margin, which measures how much money is left after subtracting the cost of goods sold (COGS). For example, if the bakery's COGS is $30,000, the gross profit is $50,000 to $30,000 equals $20,000, and the gross profit margin is $20,000 divided by $50,000 equals 40%. This indicates how efficiently the business turns sales into profit. Next, we look at operating expenses, which include costs like rent, salaries, and marketing. By comparing operating expenses to revenues, we can determine if the company is managing its overhead effectively. Another critical metric is the net profit margin, which shows the percentage of revenue that becomes profit. In the bakery example, the net profit margin is $5,000 divided by $50,000 equals 10%. A higher net profit margin reflects better overall profitability. It's also important to perform year-over-year or month-over-month comparisons to spot trends. For instance, if the bakery's revenue grew from $40,000 last month to $50,000 this month, it indicates positive growth. Conversely, if expenses are growing faster than revenues, it could signal inefficiencies. Income statement analysis isn't just for accountants. It's valuable for business owners, investors, and lenders. Investors use it to assess profitability and growth potential, while lenders check it to determine if the company can repay loans. For business owners, it's a roadmap to identify strengths, weaknesses, and areas for improvement. In summary, income statement analysis is a critical tool for understanding a company's financial health. By examining revenues, expenses, and key metrics like gross profit margin and net profit margin, you can assess performance and make informed decisions. Whether you're managing a business or evaluating an investment, income statement analysis is a skill worth mastering.